You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz, and we're just starting out the year. It's 1/5/22. Let's talk with Gil Baumgarten, one of our favorite market analysts out there. He's still basking and taking a victory lap on his call on energy, which has turned out to be a major, major hit. And we want to get an idea from Gil of where he sees the market heading in the coming year and years ahead, and how you can play it profitably and safely without a maximum, or to mitigate risk and to maximize returns. So on that note, hey, if you got a question for Gil, shoot me an email, kl@kerrylutz.com. You can also find Gil at segmentwm.com. And Gil, Happy New Year. Welcome back. So quite a good call on energy. We're talking pre-call. I call it the triple threat. You got dumb environmental policies. You got dumb politicians who are restricting supplies at the same time where we need more supplies than ever. And I don't remember what the third one was, but
inflation.
Of course, energy is the ultimate inflation play, even more so in some ways than precious metals.
Agreed. Yeah. Happy New Year to you, and thanks for having me back. I do think energy is going to continue to go higher. My firm is long shares of EOG. We're long shares of Marathon Petroleum MPC. We are long the XLE Energy ETF. We are long the XOP smaller drillers. That would be the Diamondbacks and not the Exxons of the world. And then we own minerals outright. For my family, we own minerals in West Texas and have been accumulating those. And anyhow, we're very hopeful for not hopeful for a bad energy policy, which you had alluded to, but the hedge against that is to be long energy to reduce the sting. So we think it's going to continue.
Yeah, I'm inclined to agree with you. I really like Natgas better than anything else, because Natgas, for at least the past decade, perhaps longer, has traded at a discount to oil. Based on BTUs, substantial discount.
That
substantial, because you should be trading at 16 to 1, and it was trading at way, way higher ratio than that, meaning one barrel of oil, 16 million BTUs. That should be what it's trading at, but it's trading at a ridiculous point. Oil has advantages in terms of transportability. Natgas, you got a lot. You can't ship as much of it unless you liquefy it.
Yep.
So, there's issues with it. But Natgas, there's been a shift in the United States because of that discount. And
but you could also add a premium back in there that should exist for the cleanliness of how it burns. Environmental policy with what it is, I can make the argument that it should actually trade more than the BTU equivalent of oil, despite the factors that you previously mentioned about transportability.
And we agree on that. I think there is an argument, especially because it is a cleaner fuel, but it's less energy dense than petroleum. That's the issue with it. But it is clean. And there's also a thing called natural gas liquids, which is underappreciated. So we've increased our dependency on nat gas and nat gas liquids. And it's trading at a discount because the production, there were so many thousands of shut-in wells. Now we're getting to the point where I think, like you said, at least it'll trade at parity and perhaps at a premium. So, and the oil price is less important because so many nat gas conversions in industry, big users in large scale commercial complexes using it to heat, provide heat and hot water, all these things. And then, petrochemical industry has switched to natural gas as a feedstock, underappreciated, understood, if that's a word. And we could see a big bang there. $15. I mean, if you look at what's going on in the rest of the world, Gil, they're paying $15, $30, $50 per million BTU or per million cubic feet.
Imagine what would happen if we come into a really cold winter and demand were to spike. You could easily see energy go up dramatically from here. So.
Yes. Yeah. And nat gas could be the biggest beneficiary of it. So
absolutely.
Yeah, I find that really fascinating, underappreciated. I mean, it got a lot of play when nat gas hit $6.50 per million BTU. But now it's at 360 something. I didn't look at it today. And that could really, really be the buy of.
I think back in, do I recall that in 2012 or so, nat gas traded above $8?
It did.
I think that's about right. So, I mean, we could go back and make new highs above that, and you'd have almost a triple on your hands.
Hey, and you look at that. Yeah, it could be a major thing. That was due to the polar vortex or some nonsense they blamed it on at that point. But nonetheless, and then electrical generation, 38% of it is nat gas. 20, 30 years ago, it was a much smaller percentage than that.
Yeah, and Teslas don't run on electricity; they run on the grid.
Yeah, the grid that's right.
Nuclear, coal, and natural gas. So
for the coming year, it's obvious you're an energy bull. What other trends do you see happening here?
I see a macro shift back to value. If you look at what happened with Berkshire Hathaway. Producing 30% return last year when the market was up 27. And Berkshire Hathaway is a relatively sleepy conglomerate, but 30% annual returns in a 27% market are a rarity out of that, which, it's kind of the ultimate value play. And you'll see a lot of it, the shift back towards value. The rise in interest rates that we're starting to see is putting a lot of pressure on tech stocks. There's been a lot of fast money that has been chasing the tech stocks, and those people are getting spanked about now. So I think the shift back towards value, which has really been a decade in the making. So even though you might have missed the first 5 or 10% of that reversal, I think there's a lot of smooth sailing ahead of us with regard to that shift. So.
Yeah. And along those lines of value, I think dividends will again come into vogue. When we get into slower market growth periods where capital gains become elusive, then a lot of investors look at the cash flow aspects of the so-called dividend aristocrats. Yep. And then there is the dividend nobility that fall under the aristocrats. Those could be companies that have rising dividends for decades, perhaps, but have had a few misses over the years where they couldn't increase dividends even though they wanted to. And so they didn't get the premium that the aristocrats got. Although in many aspects, those companies are as good or even better than the aristocrats.
Yeah. So you're speaking my language because my firm runs a rising dividend tax efficient portfolio as one of our 3 equity sleeves that we run for clients. We own names like Accenture, Home Depot, Goldman Sachs, Zimmer, Medtronic, Pfizer, Home Depot. There's just a whole cadre of names that we own, and we don't buy it for high yield. We buy it for perpetually rising yield. And then, of course, dividends are capped at a 23.8% tax rate, or about half of whatever your ordinary income tax rate is. So it's a tax efficient way to collect income. And then the increase in market value is tax-free if you hold it forever. And so I think that's a low turnover rising dividend strategy is a very powerful wealth compounder.
Yeah, there's that story about the lady that just owned Coca-Cola for like 40 years, never sold a share. And this is 20, 30 years ago. She died and she had a $30-40 million estate.
Yeah. It happens.
A lot of patience there.
That's right.
My sister bought $800 worth of Apple when it was $8 a share. And she basically saw it go up 1,000-fold. So it does happen.
It does.
Be a little lucky and you got to be a little smart, right?
Yep. But what is it they say? Fortune favors the bold.
Yeah.
So, you got to risk it to win it.
Yeah, you got to be in it to win it. That's for sure. So looking ahead for the year. So maybe these dividend stocks, which could be a subcomponent of value. Those are companies that actually make money and give it to shareholders. Well, what about REITs and real estate? What's your take there, Gil?
Don't just survive, thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I'm a little concerned about traditional real estate. I think the pandemic is still going to have long-lasting effects on what I would consider to be traditional real estate, both from the malls having suppressed traffic, and I don't think that the return to the office is really ever going to come back. I'm getting ready to renew my lease here at my office, and I'm noticing how weak office space rents are. It's good for me, bad for the REITs. So that would be one caution. We like the more non-traditional type of REIT, like American Tower. I don't think American Tower is actually organized as a REIT, but it is a real estate play. So there's several data center REITs that also exist. Cirrus One would be one of them, and so there's just several places to collect the yield and have a sort of a technology spin on the real estate space.
Okay, that's interesting. Residential real estate?
I think a lot of the money's already been made in that. It's not something that we participate in. It's Blackstone, I think, has a residential real estate fund, but I think I recall that they're trying to shut that down. So not something we would be interested in.
All right, but what do you think of home prices for the coming year?
My son's in the market for a home, and I'm telling him to go ahead and bite the bullet and buy it. You don't know what the lumpiness is. There's been over the last 60 years that I've lived in Houston, there's been very few down markets. Back in 87, we had a tough 86, 87. We had a tough market. Had a tough market in 08. But other than that, prices have pretty much risen steadily. And then if you're in any of the fortunate areas like Texas or Florida, where New Yorkers and Californians want to move, that creates a backdrop of decreased supply and increased demand that will only drive prices higher. So that would be my thoughts on that.
I agree. And, this was a great year for me. I bought a house and I bought it just at the exact right possible time. I went to contract at the right time, which was in February. By the time I closed in June, I had a 20% gain, thought of flipping it. But then I was like, where am I going to live?
That's the issue with the house. So, you have a lot of utility that is separate and apart from the business end of it. One more name that I thought of to back up for a second. We also own Equinix. Equinix is the largest data center REIT in the U.S. That's in our dividend strategy, and it pays a yield also, just FYI.
What's the symbol on that, please?
EQIX.
EQIX. Well, data centers, something that's only going to get hotter. Until there's a better replacement for it and there's strategic points, you get to build a data center in a place where nobody really wants to live, right?
Yeah, we bought it 2 years ago at around $300 a share, and I think it's $800. Hang on a second, I'm pulling it up right now.
Good move.
Yeah, it's down $13 today, $802 a share.
Really?
So,
wow, yeah. Excellent. All right. Well, so the coming year, is the Dow going to flourish because it's a more defensive group of stocks? I would think
ETFs like IWD, which would be the Russell 1000 Value Index, would do better than the Growth Index. Berkshire Hathaway is the largest holding at my firm. It's my largest personal holding. I have more personal money in that than anything else, even my mutual fund type holdings. So that would be something we would be looking at. It's also extraordinarily tax efficient because it does not generate a dividend. It takes its would-be dividend and it allocates it to its sub-businesses in a tax effective move. Why would Warren Buffett on his $81 billion worth of Berkshire Hathaway want to be paying taxes on $2 billion worth of distributed dividend when it otherwise could have accumulated as a deferred capital gain, which would give him better compounding on his wealth and give him the potential for a step up in basis, which would be tax-free at his death. And at nearly 90 years old, I think that's a very effective move for him. And we can just tag along and do the same. Just by buying his Berkshire B shares or the Berkshire A shares, if you can afford one of those at nearly $400,000 per share.
That's really interesting. And the first time we spoke, you mentioned why ETFs are so much more tax efficient and from an estate planning standpoint, much more effective than mutual funds. Could you just explain that again? Because I'm sure many out there don't remember or have dim memory.
Just view an open-ended mutual fund like anything that Fidelity offers. I'm just going to pick on them because they don't offer ETFs. Any 5-digit mutual fund symbol is an open-ended mutual fund. It opens and closes every day and lets people put money in or take money out. That's fine. And most days those are balanced where the people who want in is about the same as the people who want out. So they're just swapping cash and shares between the entrants and exits. But on big days where you have a $100 million purchase or a $100 million redemption, that's an aberration. On the redemption side, they have to sell securities when the door opens at 3 p.m. to let the money out. They would have had to have created the sells during the day. And what ends up happening, because open-ended mutual funds have commingled accounting, every shareholder is going to get a distribution from the gains caused by the $100 million redemption. That's not the way that's not the way ETFs work. ETFs allow the securities to be purchased in the open market that represent the underlying ETF shares, and those just sort of fly over the wall into the ETF, and then they throw ETF shares back over the wall. Everything is fine. Well, what ends up happening when you have large purchases and redemptions, those shares come flying over the wall, are not reportable as a taxable event for the ETF, and as long as every shareholder is keeping track of their own individual cost basis, their basis remains relatively unchanged over years or even decades. You could have somebody who puts $100,000 in a mutual fund, becomes $1 million over time. And in a traditional mutual fund, that $900,000 increase would have been mostly taxed. That would retard the compounding, and it would give away the tax-free step-up in basis when that person were to die. In the case of the exact ETF structure in the exact same securities, you have $1 million from 100,000, and then the person dies at age 90. That $900,000 is then tax-free in the ETF. And I'm just talking about traditional ETF structure versus traditional open-ended mutual fund structure. It's a much more powerful compounder. Not to mention, most ETFs are much lower cost to hold all that while. So it's just it's a better vehicle all around. And Mr. Biden tried to change the tax rules. I'm assuming he had open-ended mutual funds who did not like the fact that ETFs had a spectacular tax advantage in some of the recent discussions on the change of the tax laws. He was trying to get that changed so that ETFs could not have that benefit. Good luck with that, because it's a structural underpinning of the way the marketplace is built for closed-end funds.
Yep. It's so true. And that could be huge money over time that we're talking about here. Thought that was a really interesting piece of advice you gave our first time we spoke. And I thought it would be good to just go over it so you understand. Also, ETFs generally have lower operating costs than mutual funds, correct?
Yeah, it's about 4 to 1 on average, but in extreme cases, it can be 50 to 1. So
yeah.
If you take the lowest cost ETFs, the fee approaches zero. And if you take the most expensive open-ended mutual fund, it could be 50 to even 100 times more expensive.
Wow,
so
that's remarkable. All right. Well, Gil, thanks so much for coming on.
You bet. Absolutely.
And we'll keep you to those predictions. We'll see how it works out in 2022. We'll be checking in with you. Always appreciate you coming on. If you got a question for Gil, shoot me an email, kl@kerrylutz.com. Don't forget, sign up for a free newsletter at financialsurvivalnetwork.com. Gil, we'll talk to you again real soon.
Okay, man. We'll see you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.